Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this week's Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's episode, we'll talk Bed Bath & Beyond, we'll talk about retail store maintenance, and we've got a few other stories, including Ascena Retail Group that we looked ahead to in last week's podcast. A reminder to please rate us on Apple Podcasts, Podbean, SoundCloud, or however you listen to us weekly. Find us on Twitter and Instagram at Retail Podcast. We could certainly always use the followers in those two platforms. We're brought to you this week by AdRoll.com, who can provide you with e-commerce marketing tools to boost your business. Well, we start today, Bed Bath & Beyond. More poor results from them, and this from their second quarter, leaving us to wonder how analysts had positive expectations even for the embattled retailer in the first place. They've been struggling more or less over the last few years, and Leighton, for retailers, the home goods arena very much hit or miss.
Absolutely. You see a lot of boutique retailers, which we'll talk about here in a second, really taking a lot of market share from Bed Bath & Beyond. Even though a lot of our listeners, a lot of the people out there that shop Bed Bath & Beyond look at that retailer like a home goods powerhouse, they haven't really been that the last couple of years. They've been losing a lot of market share, and they've been losing a lot of their core customer base, which is very concerning if you're the leadership there with this company. However, we've been talking year after year at this point on the podcast about several initiatives that have fallen flat, but some are actually taking hold with the company. But first, let's dig into those sales. Those all-important sales for the retailer were flat. They came in at $2.94 billion, less than the expected $2.96 billion from analysts, and below even the forecasts that were internal. So leadership always etches out their plan for the year. Their plan for the quarter came in below those forecasts. Did sales. Same-store sales were down 0.6% rather than growing the 0.3% that analysts expected. And while some retailers have had great comps in the face of negative same-store sales expectations, Bed Bath & Beyond is one where you don't see long-term acceleration in average basket or traffic count. Quite concerning for this retailer, despite many of their competitors having favorable retail earnings. Earnings per share fell to $48.6 million. Still a positive that they were profitable this quarter, however, extremely less profitable than they were a year ago. This number, $48.6 million, you can compare that to the $94.2 million or 67 cents per share they had a year ago. And this massive decrease was actually expected by management, but analysts surveyed by Thomson Reuters were actually a bit more optimistic or a bit more hopeful of 14 cents per share more for the second quarter. Neil Saunders, managing director of Global Data Retail, said that these poor numbers need to be set against the context of a robust consumer economy where spending on homewares and home-related products has been rather strong. Framed in this way, the numbers are a little short of terrible and underscore the myriad of missteps Bed Bath & Beyond is making. And this really echoes what we've been saying over the past few quarters. And for us, it is obvious that the precipitous decline of profits is brought by a larger outside factor. That factor being that less people want to go to their stores. More people want to buy their products online, and Bed Bath & Beyond has not done a great job with their e-commerce initiatives. And even though they've tried to maintain price points in their store, maintaining competitiveness in that arena has really eroded their margins, and you can see that. It's not just the capital expenditures that have caused their earnings misses here in the recent past. It is the fact that they have to have lower prices or at least maintain certain price points on certain items in their store to remain competitive for their consumer. We also have to keep in mind that Bed Bath & Beyond is an almost 50-year-old retailer now with a fairly substantial dividend, making change even harder because this is a company that's been around a long time, and you've built up a certain reputation, a certain expectation, if you will, with your larger shareholder base. A lot of institutional shareholders out there that have a stake or a large stake in Bed Bath & Beyond, and no one is going to be too pleased if they cut that dividend to zero and more aggressively implement meaningful change within the company. Whereas you look at the competition out there in the e-commerce side, the expectation with Amazon shareholders is that they've been able to look forward to continue reinvestment despite not really having a lot of profit there on the retail side of that business. So you've heard our general thoughts on the financial results from Bed Bath & Beyond and a quote from Neil Saunders out there. Now let's look at what management had to say for their troublesome second quarter.
And CEO Steven Tamara on the call, started his portion of the call off with mentioning how the poor weather, most notably the hurricane out east, had affected 63 of their stores. Now, all of these stores were back to running within 8 days of damage. And of course, not a lot of that impacted this particular quarter. It will impact the next quarter potentially, though. He assured shareholders, Tamaris did, that their current strategies touch all areas of the business and are all focused on one thing: long-term earnings growth. So he kind of stayed on this platform where just because they fell in terms of sales in this quarter didn't mean that they wouldn't be positioned for strength in the future. Tamaris did say that one key driver for success for them is going to depend on in-store personnel, something they've been preaching for many quarters now. The one thing that may make a positive impact for the company going forward is all of the new hires at the corporate level. Tamaris said that they have made strides, especially in hiring the best in IT, data analytics, logistics, and supply chain in order to better leverage expertise. But again, a lot of this is just talk, and we'll have to wait to see if there are any results that actually come from these hires. Now, we can assume many of these outside hires had worked for other companies that either are currently or at one time had done something better than Bed Bath & Beyond. It's critical that senior management here recognize that these new insights from personnel have to be taken into consideration at the highest level, and that simply hiring individuals that have been successful in the past doesn't guarantee a structural change. You have to be ready to receive inputs from those individuals. Management has seemed to be understanding this very essential concept so far, but again, we haven't seen it borne out in results. What they have been doing, though, is they've been adjusting groups, organizational structure, and making changes within their company. Now, sometimes corporate realignment, you think of it as laying individuals off or combining whole divisions, or in some cases, rearranging deck chairs on the Titanic. But in this case, at least per their statements, they're taking a thought-out approach. Granted, they wouldn't say anything different if they weren't taking a thought-out approach, but what they want to do is make better functional teams. Now, the words or phrases that struck us on the call were embrace change and continuous improvement, and another one is rapid pace. Changing for the better often takes time, and I'm not sure they're going to see that rapid pace on the turnaround, at least yet. And we've not seen much in the way of results over the last 2 years after similar remarks. It's a lot of lip service, basically, towards analysts. Now, as far as what they've actually been doing to try and boost sales, they've added about 42,000 different items and decorative furnishings. This has been a category that many boutique retailers, those that Leighton spoke to earlier, have looked to in the recent past for growth. And by the way, this double-digit increase in category assortment is with Bye Bye Baby as well, not just Bed Bath & Beyond. Bye Bye Baby obviously still has a fairly good opportunity in the U.S. with Babies R Us closing their doors, but once again, a lot of different retailers jumping into that segment, and people just aren't procreating in the U.S. at the same rate as what they had been. Now, in all categories, Bed Bath & Beyond as a company is looking to eliminate less profitable SKUs. Well, glad for that, because they've got a lot of SKUs at this point that are probably less profitable. This seems similar to what we heard 2 years ago when they started scuffling here in this last little stretch. And hopefully in their decision making, they're not eliminating top sellers by only looking at the bottom line of their different products. That's a quick way actually to alienate your customer base, and that's something that Walmart found out about 8 to 9 years ago when they tried the same thing. Now, a new store concept for them will bring to light a more open merchandising theme. They're to have opened more than 100 pilot locations for this new store concept by spring of next year. They also have next generation stores, which are not part of the pilot store program, as next generation stores are kind of new altogether, making a better use of the square footage, things not stacked quite as high as you're typically used to with a Bed Bath & Beyond. And they're going to look to have 40 new stores in that same spring 2019 timeframe.
Now, there's two last things we have to mention from the earnings call. They are expanding their college and dorm assortment. This is something that Trent has actually preached on prior podcasts, saying that a lot of stores are trying to take advantage of this new space. I, for one, had mentioned a Target store that I had visited where they have an entire dorm category in an area that is normally dedicated for seasonal. So obviously Bed Bath & Beyond leadership sees an opportunity there. And with that, they're tying this category, this newer category, this foray into a very emerging category, into their IT improvements in store. They'll have a checklist tool where parents can better identify the things that they need for their son or daughter as they go off to college for the first time. They will also have a college savings pass for those who sign up, and they're targeting the students here. And it's intended to give students discounts both in-store and online, and create an early awareness in the brand for those younger individuals who may have not shopped at Bed Bath & Beyond previously. Shares of the company, ticker BBBY, sit around a 20-year low. Shares are trading around $15 a share per the recording of this podcast on Friday, where they started off at the beginning of the year around $23 a share, just over a $2 billion market valuation. However, still pumping out a robust dividend, which is right around 4.2% now for the company, given that current share price. Well, we move on with a friend of the program. The Professional Retail Store Maintenance Association released their 2019 Retail Facilities Trends Report this week. The PRSM is a membership organization for retail facilities and vendor professionals, and they are usually our go-to for not only maintenance-related information, but also building structure developments in retail overall. And overall, they have 950 member companies under their umbrella, and this report speaks to some of the larger trends in terms of the structures and processes for retailers throughout the United States. Some more notable findings within this study: they have 5 overarching trends regarding facilities management in retail. More mixed-use developments and experiential outlets in retail centers. This is something we've been talking about, especially with those older, antiquated indoor malls. Also, partnerships between restaurants and retailers, yet once again, healthcare tie-ins to big box retail, battery storage for in-store energy needs, use of blockchain for execution of maintenance and improvements, where you can better track how things are going along with different maintenance requests and that sort of thing. We'll start at the beginning, where spaces that were once completely retail are now becoming much more integrated with other segments. These include services, which have been traditional retail center mainstays, things like salons and dry cleaning places. However, PRSM is seeing an increase in fully mixed developmental space, what they refer to as retail and service ecosystems. These include, in some cases, entertainment and services, office or corporate space, and residential space. I, for one, actually live by an old conventional mall that has actually turned into both entertainment and an office space. So this really ties into what is actually happening on the ground level. We've mentioned several times about gyms like Planet Fitness taking over big box spaces vacated in strip malls. Also, other gym formats doing the same thing with outlet malls. They are certainly a big player in this concept, and certainly helping the top and bottom line of those landlords. Generally, we're seeing a return to the pre-1950s, where people are working and living in and amongst retail and food outlets, rather than having them segmented in different parts of the neighborhood or the city. As far as restaurants and retail are concerned, nothing too notable there. Their study does mention that 66% of mall visitors say that food and beverage offerings are important, and an important deciding factor for them when it comes to deciding where to spend their retail money. Trent was actually in a C-class mall in a mid-sized market recently, where there were half as many food vendors, around 4, as retailers. So you're seeing right there, 50% of the people there were actually food vendors. So important to note there.
And one of the other things this study noted was food halls as an increasing trend. Now, this isn't necessarily specific to what one would typically think of as retail, but one in particular, one of these food halls that stands out to us, is Avanti Food and Beverage up in Denver, Colorado. Leighton and I have both been to Denver recently. And this particular outlet, they've mashed together a bunch of old rail cars in a historic building to essentially make a 21st century food court with popular food trucks in the area. Now, moving on, one of the most notable aspects of the report, at least in my opinion, was the tie-in between medical and retail. While we're well aware of the trend of clinics and various medical outlets like eye care centers, for example, in a Walmart, inside retailers. This report looked at the trend from a maintenance perspective, and something that the report points out is the need to meet legal requirements for these spaces. So, for example, a cleaning crew for a retail store has to be educated and informed about the legal requirements for cleaning in those medical spaces if the medical provider is not responsible for it themselves. And these type of things, when you're talking about the legal requirements, it includes disposal of sharps and disinfecting surfaces and other medical specific aspects, all while maintaining patient privacy, which of course is of the utmost importance. So really you transition from being a retail maintenance firm in that circumstance to being a healthcare maintenance firm. The needs for those are completely different. Additionally, the maintenance itself for medical equipment is handled much differently than the maintenance of most traditional retail fixtures, and so stores may have to choose to retain maintenance firms that specialize in medical above and beyond their existing maintenance firms, at least if they're not completely subletting out the space. And the study does go on to note that. Finally, the need for specialized or enhanced lighting was a good point that we hadn't really thought of before, because these spots, these doctors' offices or dentists' offices or optometry centers, they need different lighting and different energy needs in general. And this may cause retail maintenance crews to have to stock additional types of LED lights, and it may cause some inventory inefficiencies on that end in potential. Speaking of lighting, the report noted that utility costs account for 35% of operating costs for retailers. And that said, anyone that's ever worked in retail knows that energy usage isn't always uniform throughout the day. And so for retailers that have made a clean energy pledge, this can be an expensive proposition. And in fact, the same study found that certain retailers are paying up to 50% of their power costs in demand charges here. Some retailers are beginning to find ways around those demand charges, basically that take place during peak hours of energy usage, with in-house battery storage, essentially pulling energy off the grid during non-peak hours and then distributing it during peak hours to help to mitigate those costs. This wouldn't be something that was available 10 years ago, but battery storage has improved significantly to the point where now it's no longer such a space burden on retailers. Those batteries used to take up a lot of room, now not nearly as much. And the study also suggested that energy storage among retailers may triple over the next few years. So you're going to have a lot more retailers looking to in-house battery storage systems to mitigate their electricity costs. But they mentioned too, PRSM did at least, that this would take a big leap forward, and the first big leap forward really in 2019. So we're both pretty anxious to see how many retailers truly adopt those in-house batteries. And finally, the study did mention blockchain, as Leighton talked about, the benefits of blockchain that retailers are finding and retailer maintenance firms are finding. Being able to take a closer look at historical data regarding maintenance and facilities management, and also allowing companies to more accurately time necessary staff increases or decreases. Additionally, the added security of blockchain is seen kind of as a boon here for retail facilities management.
Overall, PRSM seems to indicate that a number of trends we are already seeing in retail stores actually will continue to grow throughout the next couple of years. This includes an increased eye towards multi-use spaces and energy efficiency. Although we don't discuss it often, outside of maybe LED lighting, most larger retailers have significant staff resources devoted to energy efficiency because of the bottom line impact of utility costs. And you see, honestly, throughout the United States, utility costs, they're not going down, they're going up. So this is something that everyone needs to be very aware of in their business. We're likely to see continued strides for even the most value conscious of retailers in this regard. Additionally, it will be up to contractors and real estate developers to meet the increased demand for not only multi-use spaces, but energy efficient ones as well.
Well, coming up on the Retail Focus podcast, we'll be talking about warehouse space and the shortage of warehouse space, potentially putting a strain on businesses and retailers as they look to fulfill e-commerce requests. Consistently, they're looking towards stores now to fulfill those e-commerce requests. We're going to talk with Jennifer Sherman, SVP of Product and Strategy for Kibo, about this very thing and about ways retailers can streamline their path to getting products to consumers.
I come downstairs and I overhear my mum and dad talking in our native Farsi that, potentially we might lose our last shop, and we've always had stores growing up. I guess I was just in my own little bubble enjoying my job in music, and I didn't really realize that potentially our house was on the line. We both knew something had to change. I genuinely firmly believed in the digital process, in getting our garments seen online. I knew we needed help, and I knew we needed a platform to help get our content seen and our message heard. The first campaign that we engaged with AdRoll returned 27 times the ROI. I can turn back and say to Dad, look what we've accomplished.
To learn more about how Nav Salimian turned his family business into a global retail brand, visit adroll.com/retail. That's ADROLL.com/retail.
We love talking about logistics and fulfillment on the podcast, and several times we've discussed the ongoing struggle for retailers to update their warehouses based on the needs of fulfillment in 2018. This is often easier said than done, however, as a recent study by CBRE noting that the average warehouse is over 34 years old indicates that there's a long way to go in terms of updating some of these facilities. And here to talk about dynamics of retail fulfillment and more specifically how retailers are increasingly using alternative means as a gateway to improve logistics is Jennifer Sherman. She's the SVP of Product and Strategy at Kibo. Thank you so much for joining us today, Jennifer.
Absolutely, Trent. Glad to be here.
Now, first, could you describe some of the more generalized macro-level problems we're seeing with warehouses and retail fulfillment today?
It's funny. I remember my very first internship, I actually came up as an industrial engineer, and I was assigned to a warehouse that was doing fulfillment for a common foods brand that we've all heard of. I don't need to name. And they were shipping to Walmart, and they shipped to Walmart distribution centers. And what they had was a fully automated, lights out warehouse optimized for shipping pallets. And this thing was a marvel, right? Pallets came in on a conveyor belt. They were automatically stored. They were automatically pulled when the time came to ship them and automatically loaded right onto the truck with an automatic label slapped right on it. And about 2 months before I arrived at that warehouse, Walmart called them up and said, we don't want you to send to our distribution centers anymore. We need you to send directly to our stores. And no store needs a whole pallet of your product. And so this modern marvel of warehousing was absolutely brought to its knees. The pallets were now pulled, and there was an army of people in the staging area who would rip them apart, throw cases everywhere, and try to rebuild a pallet of mixed cases and manually put it on a truck. It was a terrible waste of space and technology, and really kind of slowed that warehouse down to a crawl. And I think we think about that, that is just a move from fulfilling pallets to fulfilling cases. And now we as a supply chain are expected to fulfill eaches and deal with a complete shift in our automation, in how our warehouses are designed, in how our picking flows execute, not to mention the back office changes. Now a brand who is expected to ship to retailers has to stand up a call center. Folks who are used to dealing with questions from professional buyers at a retailer are now having to deal with calls wondering if that toy is going to arrive in time for Timmy's birthday. Now have to take credit cards when they're used to dealing with purchase orders and electronic transfers. Now have to understand fraud risk and fraud rules. And it's really a tremendous strain on the back end, particularly for brands who have never sold direct to consumer. But I think, that problem is there for retailers as well. If you built a supply chain that was geared towards store replenishment, that same supply chain now has to deal with parcel shipping to individual consumers. And that is a pretty big realignment of a supply chain that I think modern consumers don't really think about. Why can't I get it tomorrow in the package size I want? And I don't think anyone really realizes how much of a shift that is for our infrastructure and our back-end supply chains.
Well, since we are going from pallets to individual items, we have the busiest shopping season of the year approaching in the holidays. We were just talking last week about how most projections are seeing that e-commerce fulfillment that you're referencing going up by double digits. So aside from going from pallet to individual unit and to eaches, what are some other bottlenecks that might exist in this current system that people are trying to overcome?
I think the one that we are all talking about is the transportation leg. Will there be enough capacity in UPS, FedEx, and the Postal Service? And how do we extend that capacity? And I think that is going to be the problem of every holiday season. I think this threat of the Canada Post strike up in the north has everyone keenly aware of how at risk and how brittle our transportation systems are. I think we're looking at how the Uber model is going to change the transportation of goods as it has the transportation of people. I think we're all waiting for the cost to come down on Uber or Postmates or Shipt or whoever your solution is that allows that peer-to-peer delivery. I think that not only could increase the capacity in our transportation networks, but also make available same day fulfillment in a way that has never been economically feasible before. But I think that's the one we're going to have to watch. In addition to, can I bring in the right level of trained staff in my store, which has always been a challenge? The new one is going to be transportation, particularly as folks seek to avoid the shopping rush as in the holiday season. So it'll be interesting to see how the transporters, how our big shippers rise to the challenge. And it'll also be interesting to see how new business models rise up and how financially attractive they're going to be for our sellers today.
Aside from the transportation that you mentioned, a lot of retailers turning towards platforms like Instacart or Shipt and what have you, what are some other ways in which retailers can adjust their approach to make things a little bit more efficient when you're fulfilling customer to customer?
I think we have to think about a couple of things. One, as we move more shipping to ship from stores rather than ship from distribution centers, we've got to think about a couple of things. First is the sales attribution model. Do we really have the right incentives put in place for those store associates who are now expected to fulfill online orders, whether that's buy online, pick up in store, or shipping from a store? Am I incenting them correctly so that they will deliver the best possible experience and the most efficient shipping? And, I still don't know that all retailers really have that nut cracked and really have the key to understanding where their sales come from, even if they originate online. So that's the first one. I think the second one is I test out buy online, pick up in store a lot. A lot of our customers use it. I want to know how that experience is delivered. I want to know how their competitors are delivering that same experience. And I think while it kills me, I am a software vendor. My first love in life is software, and I wish it could solve all problems. I think we really need to think about the aspects of the in-store pickup experience that aren't controlled by software. How long is someone having to wait in line? Are they dealing with a store associate who actually knows what they're doing? Or are they going to need to go get help? Is the order actually ready? Was the communication clear, efficient, and precise to the shopper? And I think we still haven't nailed the intangible aspects of the customer experience through that delivery journey, particularly in buy online, pick up in store transactions. And so we really need to look at efficiency not only from the store associate's perspective, but does the consumer have the most efficient experience possible? And I don't know that that's always going to be Walmart's drive up and we will bring the product to you, because one of the beauties of buy online, pick up in store is that consumer generally adds more to their shopping cart once they walk in the door. And so it does not need to be a zero wait time, you don't even have to get out of your car experience. It just has to be a great one. And that means we've got to do a lot more mystery shopping. We've got to do a lot more walking through the process so that we understand the bottlenecks and the things that degrade the consumer's experience.
One of the things you discussed in the first part of that answer is store fulfillment of orders and ship out of store, so to speak. And we're seeing a lot of that now, whether it's apparel retailers or even a retailer like AutoZone, is we're seeing that in-store level fulfillment of e-commerce orders to be then sent out to homes. Why does adopting this strategy make sense for retailers?
It absolutely makes sense for retailers. I think about a couple of things when I think about store level fulfillment. In the world of just plain shipping from store, the inventory in a store is a much bigger risk traditionally than the inventory that's sitting in a warehouse. Particularly if you're thinking about fashion, there has to be someone in your local geography that is of that size, that wants that particular color and style. And that's a tremendous amount of risk. And that's inventory that you could be offering up onto your website. And so you're alleviating that inventory risk. You're increasing your turns with inventory that otherwise was just going to get stale. But I think the buy online, pick up in store journey is even potentially more powerful, right? I mean, we still have to acknowledge, as much as we were talking about the retail apocalypse last year, and as much as we talked about the death of the store last year, and everyone was predicting doom and gloom, stores are still the highest conversion channel that a retailer has. And they are still the highest traffic, from a valuable traffic perspective that a retailer has. And so those customers who walk in the door are more valuable, or have a higher conversion rate, and will potentially add more product. And so if you can deliver them the convenience of same day or next day pickup options, they will deliver you a larger basket size. And so it is a win-win for both the retailer and the consumer if we can nail that experience to get them in the door. Now, we've got to think about all of the logistical problems that this brings, right? We are asking the store associate to do more work. We are asking the store to serve more functions. Do we have the room? Do we have the physical space set up? Do we have the systems in place that make that easy for the store associate to deliver on? But if you can, you've got a great use of inventory, you've got a great use of your space, and you've got a great vehicle to bring shoppers back into the doors of the store.
I want to bring it now full circle as we kind of wrap our discussion up a little bit. I know Kibo serves both manufacturers and retailers. Given your perspective, what are some differences in serving both parties?
Sure. I mean, I think first and foremost, manufacturers tend not to have stores, right? There are obviously exceptions where manufacturer has crossed over to become a retailer. But for the most part, we generally think of manufacturers as being somewhat handicapped because the convenient options that customers love, the buy online, pick up in store, the ability to ship from stores and therefore ship more locally and ideally faster than from, a centralized distribution center somewhere in the middle of the country. We generally think of those options as being locked out to the average manufacturer, but I think it's actually not true. Manufacturers are often in more stores that are closer to me than a comparably sized retailer because they sell to multiple retailers. And so their product is in more doors. And what that means is that if the manufacturer can get access to the inventory levels in their retail channel, or sometimes even if they can't, they can offer a greater degree of customer convenience than a retailer could if they think creatively about how they're going to do that delivery. I'm particularly excited by programs like Maui Gym, who allows you to reserve online and buy on store at your local optometrist, right? Maui Gym knows that, at their price point and for sunglasses, customers often want to try those things on before they buy them. And so what Maui Gym has said is we're in more places than there are sunglass huts in this country. We're probably closer to you. And so look for the pair of glasses online and we'll tell you exactly who carries it in your neighborhood. And we will make sure that it is available to you when you want to go in and try those on. We have hundreds of brands at Kibo who make use of omni-channel programs through their retail channel. And I think that there's a tremendous opportunity for brands to offer even greater convenience than retailers can. And it takes a more creative solution. It takes a little more collaboration. It doesn't always mean that you have to have inventory levels from your channel in order to deliver it if your channel is automated enough and can respond quickly enough to consumer inquiries. The day and age in which you go to a website and you see our product is available at these fine retailers, without telling you the inventory, without telling you where specifically you can go to get the product you want, is over. But that doesn't mean that the omni-channel opportunity for a brand is over. They have a greater opportunity in some cases than even retailers. It's just going to require a more creative solution to get there. And so I think the time has come for brands to start thinking of themselves as players in the omni-channel game, in the retail game, albeit with a more distributed distribution model, which is the same as franchises and co-ops have had to deal with for years, and they've made it work. So I think the brand opportunity could be the next big wave in the omni-channel story. I hope it is the next big wave. I hope that we learn to share supply chain to make it feasible and possible for consumers. And in exchange, if they're willing to offer this, what the manufacturers will get is a much more granular level of demand data than they have ever seen before. If their websites can offer buy online, pick up in store, or can even sell if they're drop shipping through their retail channel, then what they will get is demand level by SKU, by trade zone or zip code that they can use to further penetrate their retail channel. If you're offering up all of your product and you are letting consumers know exactly where it's available and where they can go pick it up, then you are getting very clear demand data that you can take back to your channel to say, hey, these are the opportunities you're missing as a retailer by not carrying product that is more in demand in your neighborhood, your city, your zip code. So I think there's a real great opportunity there for manufacturers to unlock that I'm really excited about, that we're excited about at Kibo. And we've been partnering with brands for decades in getting them online, in getting them to sell, in getting them to better leverage their retail channel to distribute to consumers. And because even today, when we think about brands and we think about the products we want to buy, our first instinct might actually be to go to that brand's website. And it's still disappointing to see how many of them don't yet sell online when the opportunity is there. And solutions like that, solutions that have you drop ship through your retail channel, solutions that have you offer buy online, pick up in store through your retail channel, also can solve some of those problems that we were talking about earlier. The I'm not used to shipping anything but pallets or cases. The I couldn't even spell fraud. The I don't have a consumer call center. That sort of solution can be solved for if you get the right technology partner and the right retail channel partners. It can actually make going online much easier for brands to do and offer solutions to all of those other problems. I think that is an omni-channel program that Kibo is very excited about. It's frankly the reason I am at Kibo, because I believe in the omni-channel opportunity for brands. I think it could be the next big wave in retail commerce.
Jennifer Sherman, SVP of Product and Strategy at Kibo. Thanks so much for joining us today on the Retail Focus podcast.
Thank you. It's been great to talking with you, Trent, and best of luck in your holiday season with your shopping, and best of luck to all the retailers and brands out there.
Once again, we thank Jennifer Sherman for joining us here on the Retail Focus podcast. And once again, a reminder for you that have made it this far into the podcast, please rate us or like us wherever you do access us. As we get into the second portion of our news segment on the Retail Focus podcast, well, the Versace deal got confirmed on Tuesday after the rumors of the Michael Kors buyout were really starting to heat up. The deal's worth about $2 billion, but it's leaving some on all ends of the equations confused and potentially frustrated. Now, the deal is actually for $2.12 billion. And we'll see the Italian fashion powerhouse turn over the reins to Michael Kors, which has seen its fair share of ups and downs over the last couple of years. Michael Kors will also no longer be named Michael Kors, but rather Capri Holdings. That'll take us some getting used to. The main aim, just like with other acquisitions of this type, is to grow from a well-known fashion brand in Versace and leverage the name in order to grow sales. Sadly, a lot of time this comes at a cost, and one might decide to sell the acquired brand's merchandise at a lower price point, which in turn causes the margins to compress, which in turn causes them to focus on ways to reduce cost of goods sold, which in turn may affect quality. You get the idea. This is how a downward spiral works in terms of a premium brand. But looking at the immediate goals of Michael Kors, they want to increase the annualized sales of Versace from $800 million to over $2 billion.
And there's a multitude of ways that the company would actually be able to do this, Trent. But a lot of people are getting concerned that they're going to be doing this in a not so clean way. The main point here being that they will not be so intent on reducing the quality of the Versace product currently, but rather expanding and investing into an area that is objectively underdeveloped for Versace. You see that management is looking to expand their online presence in order to hit those lofty sales marks. In a press release, John Idle, CEO of Michael Kors now and future CEO of Capri Holdings, said that we are excited to have Versace as part of our luxury brands and we are committed to investing in its growth. So again, talking about moving its sales up to $2 billion, it's going to take a lot of effort. It's going to take a lot of marketing effort, something we'll get into in just a little bit. Versace leadership, for their part, said that they recognize that they need to follow through with this acquisition, and it's the logical next step in order to grow the company. So for them, it's not necessarily about the brand, it's about growing sales as well. So it seems as though the two missions are aligned, at least for now. And for now, Donatello Versace will actually stay on with the larger entity as creative director. He's the leader right now for Versace brands, but he's going to stay on board. And this is an important move for the company, at least in the short to midterm, to reassure customers, not just investors. I know we speak about investors a lot. We speak about analysts a lot on this podcast, but this particular story has more to do with their customer base, and the direction of the company and the current style trends that they're on is extremely important, and extremely important to relay to that core customer that traditional style, that type of trend that they're setting right now is not going anywhere anytime soon. Do expect, however, to see some judgment in the interim where customers are going to be dissecting those new products that they're putting out, trying to identify new flaws, either quality-wise or fashion-wise, to criticize the move of moving into the larger Michael Kors brand. It is unclear what influence, if any, current designers at Michael Kors will have over the iconic fashion brand. However, it is extremely clear that customers are already getting worried about what they deem as the inevitable. Some actually have already taken to social media only to be recognized by larger news outlets, and luckily for us, we didn't have to dig too far because CNBC actually quoted a few. Some described this future for Versace as cheap fabric for soccer moms, duty-free stuff that you can buy at the airport, a brand about to go from high-end luxury to TJ Maxx and Walmart. Bold words from what we assume to be their customer base. Experts have said that people, or the devoted customers moreover, have been assuming too much about the intent of the merged company without really knowing the true intent that the leadership has. The rebuttal argument for this seems to be basically saying that Michael Kors is buying the brand and the excellent designer team with the sole intent to use their marketing prowess online to boost sales, not to create a subpar product and abuse the brand, like what many have claimed to see what happened with Schwinn bicycles at Walmart when Walmart started to carry them years ago. One thing mentioned was the e-commerce investment for Versace, but social media has without a doubt helped the sales of Michael Kors to this point. Definitely helped over the last 4 quarters or so. The numbers of influencers they have has grown exponentially, and the number of impressions have also done well. This is something that won't necessarily destroy the Versace brand if you increase this marketing effort, but if done right, it may actually elevate it. Obviously, social media is the number one realm for marketing, especially for these elite brands. Some may question, though, Michael Kors and what they can really do in the social media realm if you compare their current followers. So you may dig in a little bit deeper here and see that Michael Kors may just be saying things to sort of pacify their core customers with Versace. For reference, Michael Kors has 12.6 million followers on Instagram. Versace has over 14 million already. This may actually give some credence to the fears that the company may not actually be looking to solely grow the brand via marketing and e-commerce, but rather maybe put out a subpar product. But we have to wait and see. For the trailing 52 weeks, shares of Michael Kors, ticker KORS, are up from around $47 a share to now around $69 a share on Friday. Shares were nearing $73 a share before this news hit. So obviously this news not pleasing a lot of short-term investors out there, or maybe even some of the longer ones. This pushed shares down to the mid and high $60 range, where it came back up to its level currently at that $69 a share mark. Currently, the company has around a $10.3 billion market cap.
Now, as I mentioned in looking ahead last week as we shift gears, Ascena Retail Group released their quarterly numbers, and honestly, they were surprising to both analysts and us on the show. In particular, the earnings per share beat was something that we did not see coming for the company. They reported their fourth quarter results on Monday of this week, and those earnings per share numbers were way better than last year, even on a GAAP basis. For the fourth quarter of fiscal 2018, the company reported GAAP income of 17 cents per diluted share compared to a GAAP loss of 8 cents per diluted share last year. Adjusted earnings per share hit a positive 7 cents for the company, more than doubling the analyst expectations. Now, within that consensus, there were some that thought there would be no way that the company would turn in a profitable quarter, even with the current positive retail environment. And honestly, You could count me among them, and I was proven well wrong by this right-sizing program at Ascena. While the quarter was great on the earnings per share front, or at least relatively great versus its previous quarters, for full fiscal 2018, the company did report a GAAP loss of 20 cents per diluted share after reflecting a comparable sales decline of 2%. But that comp sales decline overall for the year, much better than it could have been after they struggled so vastly early on in the year, bringing those comp sales up. In fact, they were losing comp sales in some divisions by double digits. Now, back to that fourth quarter in particular, we see that positive sales obviously played an important part in that earnings per share beat. Ascena Retail as a whole brought in $1.77 billion for the quarter, ended July 2018, surpassing the exact consensus estimate by over 8%. And we should mention that in this circumstance, Ascena Retail Group handles not only tween brands like Justice, for example, but also Maurice's, Dress Barn, and so forth, a number of brands under their umbrella. David Jaffe, the CEO of Ascena, commented that their fourth quarter reflected sequential comp improvement, and this is important, across all of their brands. That's the first time that's happened in quite some time, and it's the first enterprise-level positive comp quarter for Ascena since the second quarter of fiscal 2015. Comparable sales increased a whopping 4%. I say whopping for them. You have to understand this company was losing comp sales again by nearly double digits some quarters over the last couple of years. So they are going against easier comps, but to see comp sales push in the opposite direction, very positive. And excluding Dress Barn, all brands delivered positive comps. Dress Barn, by the way, still beat on company expectations, as they have seen some improvement sequentially as well, just not into positive comps quite yet. Within the call, Jaffe spoke of being more flexible in all areas of the business, also spoke of the new agility they had in terms of decision-making early on, with Justice in particular, and how that success in strategy has now been proven out among their other retail banners.
Their, and I quote, change for growth transformation not only includes how they delivered new product assortment to their stores, but also how they have managed costs inside the business. So we're talking corporate costs, we're talking supply chain, and according to management, they've been able to reduce annualized costs by around $300 million, or at least are on track to by mid-2019, and they keep citing mid-2019 as sort of the head for all of their goals. They have localized planning now in place and have streamlined processes along their very integrated supply chain now, which I feel like we've talked about at length when covering quarterly earnings for Ascena Retail Group. They mentioned how they can better leverage and strengthen their brands, but they also have to do it in a cost-effective way. And the costs, this is something they keep talking about in every facet of their business, which if you listen or read the transcript notes from this most recent earnings call, they mention the word costs or cost efficiency more than a dozen times throughout the call, really signaling to those listening or reading those transcripts that they are hyper-focused on profitability in the coming fiscal year. And speaking of the fiscal year in 2019, they are expecting all inventory models to be streamlined and much better and efficient across all of their brands in terms of what they have in the pipeline, ready to go, ready to be placed on store shelves, and what levels of merchandise each store should have. So we're talking about a company that is operating very efficiently, or at least hopes to operate extremely efficiently to better boost those margins. And they are hopeful that all of this will lead to meeting the internal expectation of 2019 for full year non-GAAP earnings per share ranging from 0 cents to around 10 cents per share. They do list the different parameters required for accomplishing a positive earnings per share mark in 2019. They said none of the end goal, this long-term sustainability, this long-term profit making, is possible unless they hit these certain marks. And they wrote this out. They wrote this out very transparently for their press release. Average positive same-store sales. They want this, again, as an average, so we could still see Dress Barn a little bit below neutral, around $6.5 billion in total sales across all units. So we're talking brick and mortar, we're talking e-commerce, we're talking all of their retail banners. 6.45 to 6.55 billion in total sales. Minimal expense growth, just at 1%. This is their target number. They only want to grow their expenses by 1% despite somewhat of an inflationary market right now. We talk about wage growth. We talk about fuel costs going up. We talk about just the general cost of doing business in the United States is going up objectively. They were pretty specific on store consolidation too, which for us, again, we love transparency, but this may be a little bit worrisome for those that want to see them keep all of their current brick and mortar stores. But this is a model also taken into consideration when talking about their future financial goals in fiscal 2019. So need not to worry. If you're a shareholder, this is already baked into their model. Ascena expects to close approximately 5% of its fiscal 2018 year-end fleet. So the amount of stores they have now are going to be dropping by around 5%, which is looking now at a range between 4,375 stores to around 4,425 by, again, mid-2019. Ascena, the stock ticker ASNA, it's doubled this year, Trent. The company's market cap is now hovering around $900 million. I will say, though, this is on the back of a very poor 2017. And right after earnings release, though, those positive same-store sales marks that you mentioned, Trent, probably helped the stock up a little bit. The company boosted around 16% when it was all said and done at the beginning of this week. Shares remained steady as well. So people liked what they saw. They liked the analyst remarks after the results came out this week. And on Friday, they hit above $4.80 a share. However, that is not the closing price. Shares did hit $4.87 at one point in time, which is really good for a company, like I said, that's had a topsy-turvy last couple of years.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
All right, we've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Leighton and I pick a story that we're looking ahead to or keeping an eye on for the next week, month, or year, and we start with Leighton.
Well, my piece is going to be a little bit more about the food industry, as Dunkin' Donuts is actually dropping the donuts from its name, symbolic of a differentiated menu and better ingredients, but maybe it's not something so positive in terms of brand awareness and respecting the company's heritage. After all, Dunkin' Donuts, the name Dunkin' Donuts has been around for 68 years and running, and a lot of statements out there from analysts and customers alike. They're seeing that this might not be good for their brand as it hurts their relevance for generations to come. And I look at this as a sort of signal for Dunkin' Donuts, in that while they have been changing inside and out in terms of their menu and the ingredients that they have in their different product assortment, I like seeing the Dunkin' Donuts name. So for me personally, I'm very curious to see what this does to sales. Obviously, you look at health trends and those types of things and how they've affected the companies that we talk about on the podcast. You look back years ago to CVS Health and how they stopped carrying cigarettes and they tried to change their brand to be more focused on healthy individuals throughout the United States and helping people live longer. That's worked out great for them. They have been doing so well, especially in the face of competition, especially in terms of their main competition in Walgreens. So the dropping of donuts will actually happen for Dunkin' Donuts in January. So the company, if they want to go back, they still have a couple months to do so. But in terms of, again, their overall brand and how they're perceived by the general public, I am extremely curious to see what this does to their sales, because honestly, even with the name Dunkin', everyone is still going to think donuts, at least for another generation or two. So with that said, I am extremely curious to see in their future earnings releases what the leadership has to say about this change and what this means for the company going forward.
So Leighton covered one type of beverage in a way in his looking ahead. I'm looking ahead at some legal issues regarding another type of beverage entirely. In fact, Total Wine and More has taken a case against the Tennessee Wine and Spirits Retailers Association all the way to the Supreme Court. Now, backstory here. Under Tennessee law, any corporation and business entity that exists may not obtain a retail liquor license unless all the directors, officers, and shareholders of the business, shareholders as well, have been in Tennessee for at least 9 years. That's right. They have to have residency in Tennessee for at least 9 years. And although this sounds almost like an inane law, these laws exist in at least 21 other states, according to Shanken News Daily. And so Total Wine has actually appealed this based on Commerce Clause grounds. Total Wine has actually won successfully in federal district and appeals courts. Now it heads to the Supreme Court, this case does. In the interim, Total Wine has been granted at least one liquor license to operate in Knoxville, Tennessee. But should these rulings be upheld in favor of Total Wine, this could really open up spirits licenses to larger chains like Total Wine, for example, in states where these chains can exist. Now, many states still have rules that allow only 1 or 2 liquor licenses per company, but again, these are starting to be challenged. These are starting to go by the wayside, and I think you're going to see more businesses like Total Wine, for example, gain more market share in areas that they had previously been closed out on. Well, that'll do it for us on the Retail Focus podcast. For Leighton, I'm Trent. Once again, a big thanks to AdRoll.com for presenting this week's podcast. And again, thanks much to Jennifer Sherman of Kibo for joining us and talking about e-commerce fulfillment and other types of fulfillment with aging warehouses in the U.S. We'll be back 7 days from now with more retail news, information, and another interview.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.